Yeah, ladies and gentlemen, good day and welcome to the Alpha Stories webinar series. Now, for those of you who are attending this series for the first time, I would like to inform you that we conduct this series periodically where we educate investors about how to analyze a business and what differentiates it from others in the sector. In case you have missed the previous sessions, kindly visit our YouTube channel, Right Horizons. We will also be sharing the link for the same. In the sixth session, we will be taking you through a contract manufacturing business in the FMCG space. Now, we have our first speaker, Mr. Prabhat Ranjan, a CFA charter holder from CFA Institute, USA, BTech from BVP Pune, and MBA from Delhi School of Economics, and an investment management professional with more than 5 years of experience in the equity research, advisory, and portfolio management. He covers manufacturing, cement, chemicals, auto, and other sectors at Right Horizons. Uh, we have our second speaker, Mr. Vijay Chauhan, who has done his BTech from IIT and MBA from IIM. Is an investment management professional who has previously raised capital with other partners based out of Surat for investing in Indian small cap and micro cap companies. He covers financial services, pharma, IT, FMCG, and other sectors at Right Horizons. And as a reminder, we request all participants to be on the listen only mode and turn off your webcams, and there will be an opportunity for you to post questions in the Q&A chat box after the presentation concludes. Please note that this webinar is being recorded. I now hand the session to Mr. Prabhat Ranjan. Thank you, and over to you, sir.
Yeah. So thank you for the introduction, Prabhu, and a big thank you to all of you for joining us on this Saturday morning. And before starting the presentation, a quick disclaimer: our presentation is just for the educational purpose, and we are holding the stock in the portfolio. So please don't consider that as an investment advice. Before investing, please do your own due diligence and research, and reach out to your financial advisors on the stock recommendation side. So coming back to the presentation, welcome to the Alpha Stories. And today we are going to know more about one of the largest FMCG contract manufacturer in India. So we are talking about Hindustan Foods, which likes to call itself the brown behind the brands, right? That we use on a daily basis. So it's the preferred contract manufacturer for brands like PepsiCo, Bata, Imami, ITC, Reckitt Benckiser, HUL, etc. So the company was established in 1988, and it has more than 3 decades of experience. Probably, if you can just move to the next slide. Yeah, next. Yeah. So it's the most diversified FMCG player in India in terms of contract manufacturing, and the company has a wide geographical footprint. It is present in 7 different cities in India and has 17 different manufacturing facilities and employs more than 1,200 employees, and touch around 3 million plus lives on a daily basis through its products and ranges. So mainly because of the wide range of product that it caters to, right from home care to personal care, then pest control to leather products. So it has the ability to manufacture all sort of products, right from the small orders to the large orders, and that's what makes it the preferred contract manufacturer partner for a lot of FMCG brands. So mainly the company was started in the year 1984. We'll be discussing a brief overview of the company in the subsequent slides. So if you can just move to the next one. So if you can just have a look at the quick milestones in the company's journey. The company was started in the year 1984 by Denko Group, which was a leading business house in Goa. And the company started manufacturing in the year 1988 through a JV with Glaxo Group, and they started manufacturing manufacturing product called Ferrex. So mainly for the next 25 years, the company was into a single product market, right? So it was making single product for a single brand. But things started to change when Case Group took over the holding company of the Hindustan Foods Limited and acquired 74.45% of the stake in this Hindustan Foods Limited. And then maybe from there, the things started to gain pace, and they doubled the capacity of the plant from 3,000 ton per annum to 6,000 ton per annum. And then mainly from the year 2017, the company has done some aggressive mergers and acquisitions, and then also did some brownfield and greenfield expansions. So just to name a few, mainly in the year 2017, they acquired the manufacturing plant of HUL. Then in the year 17-18, they acquired the RB plant in Jammu. In 18-19, they did a merger with the Vanity Case Group for one of the detergent plant. Then in 19-20, they acquired a more than 40% stake in ATC beverages plant, which was expanded the product range to the beverages as well. And then also did the brownfield expansion for HUL detergent plant same year. And then in 1920 year, to keep the aspirations of growth intact, they raised funds from market ventures like Convergent Finance and Six Sense Ventures, and they acquired some sort of some capacities in Silvassa, and then also did a merger with ATC Beverages and the GlaxoSmithKline. So mainly in the year 2021, they also established disinfectant toilet paper and surface cleaner plant in Silvassa, and also they did a greenfield capex of 125 crore in UP. And then recently that capex start commencing and the plant has got commissioned. And also they have started a home care and personal care plant in Mysuru. And very recently in the last quarter itself, the company started ice cream plant in Uttar Pradesh. So mainly we can see that a lot of company has grown leaps and bounds in last 4 or 5 years through a lot of organic and inorganic growth, and mainly mainly because there is a growing need of contract manufacturing in the company. So mainly we'll learn more about the contract manufacturing space in the next slide. So if you can just come, yeah. So mainly what has changed over 4 or 5 years, that because of the growing penetration of e-commerce, we have seen the advent of a new and young entrepreneurs coming in the market who likes to focus more on the brand building and distribution side. So mainly that has led to some sort of impetus on contract manufacturing, and then also mainly because of the standardization of the tax rates across the country. So it makes it possible for companies to produce across India, right? So that was again a key trigger. Then third was the rising disposable income in the household. So mainly the rural income is also rising, and they are increasing consumption towards the higher value chain products, right? So that has led to growth in the consumption, and then finally shift to the contract manufacturing side. So mainly why the companies go for outsourcing, mainly because a lot of manufacturing problems are very difficult to tackle with. So company don't want to tackle with the supply chain issues or sourcing problem or sourcing of raw material problems, or let's say get into the labor problems of the company, right? So maybe the contract manufacturing provides the cost efficiency also. Mainly you have a lesser time to and you have a lesser time to take product to the market. So mainly because of the economies of scale and the size that this contract manufacturing provides, you have sourcing at a lower cost, which improves the competence advantage of the companies as well, right? So mainly that has led to the increase in the contract manufacturing. And also if you look at the market itself, so the market, the entire FMCG brand, FMCG market is the 4th largest sector in India, and it has a size of around 8 lakh crore in India currently. So mainly if you look at the contract manufacturing space, it's around 15,000 to 1 lakh crore, and it's going to grow at a very rapid pace. So it's a high volume, low margin business where the margin typically ranges from 2 to 4%. But again, because of the huge volume that the company generates, the growth is kind of very robust in this segment. So if you can just move to the next slide, we can discuss on the business model through which it services to the clients. So mainly there are three verticals for the company to service its client needs. The first is the dedicated manufacturing, where the company mainly ties up with a principal partner. So mainly the principal partner determines the location, the kind of equipment to be used, the products to be manufactured, the capacity of the plant, and mainly in return, the principal partner gives some sort of commitment that the plant to be used for next 5 to 7 year time frame. And also the principal partner gives some sort of ROI commitment that let's say the product is seasonal. So the contract manufacturing like Hindustan Food doesn't suffer because of that, and they have some minimum ROI guarantee on the product that they manufacture. The second part is the shared manufacturing, which is also called the anchor tenant model, in which there is a principal anchor, which gives the maximum number of orders, and then some sort of capacity is also utilized by other brands, right? So mainly the products are fixed, but it can be utilized by different brands. So that's the difference between the first and second. And also basically the shared manufacturing, it becomes slightly the cost burden becomes slightly easy for the anchor group. which gives the order to the Hindustan Foods Limited. The third is the private labeling side, where the companies comes up with the client concept and the brands comes up with the client comes up with the concept, and then HFL, because of the expertise in this contract manufacturing space and having worked with a lot of market brands, it knows which products to take to the market and how to go about the labeling part, packaging part, and all. So mainly it provides the expertise to the new brands and then help the brand to take the product to the market in a timely and efficient manner. Now coming to the product side, so if you can just move to the next slide, please. Yeah, so mainly the products move from right from home care to personal care, ranges from home care to personal care to shoe accessories, F&B, beauty and makeup, and pest control. So mainly the most of the business comes from the home care side, personal care side, food and beverage side, and the leather product side. So mainly on the product side, in fact within the product itself, it has a lot of categories to cater to the brands. So mainly fabric care, home care, hair care, and then baby care across personal care segment. And then on the footwear side, so mainly it has men's, women's, and kids footwear segment that it caters to. And on the beverage side, it mainly into the soft beverages and hot and cold beverages, and then cereal and snack side. So these are good products, wide range of products that the company manufacture for a large number of clients. On the next slide, we'll have a look at a different brands that the company caters to. So it has a long-standing relationship with GSK, HUL, Reckitt Benckiser. Then also it's engaged in tie-ups with new age brands like Nykaa, and then some of the marquee brands like Hush Puppies and US Polo Association, which for which it does the manufacturing. So mainly it has presence in 7 different cities in India. We'll discuss about the manufacturing plants in the next slide. So yeah. So mainly the company has presence in 7 different cities, and it has 17 different plants. So right from Jammu to Silvassa to Mumbai, Goa, Trivandrum, Mysuru, Coimbatore, Puducherry. So mainly it has tried to strategically place the plant close to the area where it's favorable to produce the plant, the products. So mainly, for example, Coimbatore is very good for raw material, is very accessible for the raw material needs for a tea and coffee segment, right? Similarly, Hyderabad is known for its pharma companies and chemical companies. That's why the detergent plant is put in the Hyderabad region, right? So that's why the plants are scattered across the India in a very strategic manner, which gives some sort of competitive advantage to the Hindustan Foods. So mainly that was about the brief overview. Now we'll discuss a bit about the financials of the company, how it has fared over the last 4 or 5 years. So, Prabhu, if you can just move to the next slide, please. Yeah. So, if you look at the financial history of the company, so the revenue has grown at a CAGR of around 120% in the last 5 years, mainly from the same time horizon that the company has started to invest a lot on the JVs, merger and acquisitions, and new capacity expansion. So the revenue has grown at a rate of 120%. EBITDA has also grown at a rate of 110% from 3 CR in FY17 to 120 CR in FY22. PAT has grown roughly 50x in the last 5 years, growing by around 135% CAGR. And if you look at the gross block, which was the main reason why the company is able to generate that much of revenue, right, in the last 5 years. So mainly the assets sold by the company has grown from 14 CR in FY17 to 550 CR in the year FY22. So that has been a brief summary snapshot and puts the impressive number for the company. Let's see how the companies fare on the key matrices through which we identify the stock in our screener criteria. So if you can just move to the next slide. So mainly we have internal thresholds for picking stocks in the portfolio, and that we have discussed in the previous webinars as well, just to have a quick overview. So mainly we try to find out the stocks which have at least 8% CAGR sales growth over previous 3 years, ROE of more than 12% on a 3-year average basis, ROC of more than 12% on a 3-year average basis, and debt to equity level should be less than 1.5 for the current period, right? So mainly, if you compare the actual numbers, so that it stands at around 16.2% on a net sales basis, net sales growth basis. The ROE is 14.1% against the threshold level of 12%, and the ROC is again 14.9% against the threshold level of 12%. The debt to equity level well comfortably around 1, as against the threshold level of 1.5. So that was the quick overview on the financial matrix side. Now I'll hand over this presentation to my colleague Vijay, who will discuss in detail about the investment thesis and some of the key risks associated with the company. So what do you, Vijay, now?
Thank you, Prabhat, for taking us through the brief introduction and the financial side. So now, we have a fair understanding how the Hindustan Food has emerged from a small company to a large contract manufacturing company and a preferred choice for the large MNCs and as well as the domestic FMCG companies. Now we will look into the some of the insights, like why we are bullish about the investment and why we are particularly see the growth continuing in the particular business. So first we will go with the industry and we will try to analyze how the industries and then move on to the some of the company's plan in detail so we can see how the future will be for Hindustan Foods. Prabhu, you can move to the next slide. Yeah. So basically, to the benefit of the viewers that are attending the webinar, so basically we will start with the competitive advantages. So competitive advantages is basically something which differentiates the business from its competitors, and it helps company to carry on, or let's say the reap the extraordinary profit from the industry for long period of time. So if we look at the contract manufacturing industry for FMCG side, so let's take example of HUL who wants to give, let's say, order of detergent for particular contract manufacturing company. So they have stringent requirements around the how the specifications of the product will be, let's say for the detergent or the soap or the bar that they are producing. Also, they will have a stringent measurements regarding the supply chain and also the delivery of the timeline. So these are the very complex decisions that when HUL is considering this of giving this order to somebody external manufacturing company. So there it's a lot of things involved, like skill labor management and setting up a plant, because in FMCG we have to carry out the physical construction of the plant, and the labor should be, it's a labor intensive industry because it's a theoretically manufacturing industry where you have to focus on right from the sourcing of the materials, then producing it and converting it into the final goods, and again delivering it to the favored side of the HUL, let's say for the client. So in the 3 decades of experience of Hindustan Food has mastered this art, and they have learned from their past mistakes as well. And we strongly believe that one who has learned from the past mistakes have higher chance of success, because they have already gone through some of the worst phases in past, and now they have mastered the art, like in terms of skill labor management and also the moving capital across the various plants. Also, they have built a very strong relationship with the internal clients which they have acquired, and we are happy to announce that the one of the plant which was a beverage manufacturing plant for the Hindustan Food, where Hector Beverage was the anchor client, it has also got the order from the Tata Consumer as an anchor in the shared facility, which was later on converted onto the dedicated manufacturing facility. So now it is a long-term order book with both the Tata Consumer and Hector Beverages as well. So these are the some of the advantages, or some of the key developments which helped Hindustan Food to become a preferred partner, or let's say the one-stop solution for the the large FMCG companies in the Indian domestic market. So now we have fair understanding, like the industry has a very high entry barrier, and it has a lots of complex issues involved, right from setting up the plant or the labor management or the supply chain, or let's say the issues related to the quality control and also the regulatory and environmental issues. Now we will see how much Hindustan Food is earning for the each 100 rupee it puts into the balance sheet. So the core return on investment, or let's say the return on capital employed, is 19%. So let's say if Hindustan Food is investing 100 rupees incrementally, so they are generating around 19 rupees. So we can ask ourselves this question, like if we put the same 100 rupees in the bank, we will get somewhere around 6-7%. If we invest in the corporate bond, we may get 7-8% kind of yield. So 19% seems attractive. So why other players are not attracted to this industry, and they are also trying to set up the plant, and they can also start to take the part of this huge profit, or let's say high return on investment which Hindustan Food is generating. Basically, the things that we have put up on this slide and that discussed regarding the labor management and all the complex things that one has to master, these competitive advantages protect Hindustan Food from the new contract manufacturing partners which enter the industry, and it helps Hindustan Food to keep on generating 19% return on investment for whatever incremental capital it invests. So now we are very sure that Hindustan Food has a higher probability or higher odds of successing or protecting its 19% return on investment. Now we look how this 19% return on investment will be reinvested in the business, so that the compounding of the business can happen, and it can also lead to the similar kind of returns in the stock price as well. So now we look at the growth part, which is very important for any business to compound the wealth of the shareholders. So Prabhu, we can move to the next slide, please. Yeah. So what we have done, we have tried to analyze the global environment in the particularly the FMCG consumption side. So what we have chosen, we have basically cherry picked the 5 of the 4 different countries which are comparable to the India, considering that the table that we have shown, and we have tried to capture the FMCG per capita consumption across, let's say, the malted food drinks, face wash, body lotion, washing liquids, dishwash liquids, hair conditioners, and etc. So what we have found is basically the Indians are consuming 1x of the consumption if we are comparing with the other developing countries like Indonesia, China, and Philippines, where the consumption per capita is very high in the FMCG categories, like 2x for Indonesia and 3x for China, and Thailand has also the 10x. So we see that the FMCG has a very low penetration, and let's say the consumption is very nominal side when we are comparing with the other developing countries. So we see that there is an immense headroom for the FMCG penetration, as we can see in the other line bar chart, where we have captured the body wash, hair conditioner category, where we are looking at the penetration. So it is very minimal, and if we compare it on the relative basis with the different countries, we also see that there is a quite headroom to grow. So now we have fair understanding even on the global level. In India, we have very low penetration. We have very high growth in the FMCG market to grow ahead. Now we will look at the Indian FMCG market in a bit detail, so that we can understand it more in depth. So in India, the FMCG market is somewhere around 8 lakh crore, as mentioned by Prabhat earlier also. So if we look at the FMCG market in India, so it's mainly a 50% health personal care, 31% is home and healthcare, and 19% comes from the food and beverages. So this industry itself is expected to grow around 15% CAGR and reach to $220 billion mark by 2025. So the good thing in this FMCG industry is that it is also the growing industry. It's not a stagnating industry. So by natural, when we are like picking any industry which has a tailwinds, so any company or any business which operates in this particular industry will have a natural advantage of a growth which is coming from the industry tailwind side. So that's why we are very optimistic on the sector as well, and also it is also the 4th largest sector in the India. So based on that, we can estimate around 50,000 odd crore to 1 lakh crore of demand, which is also estimated by the Hindustan Food Limited as well. And we strongly believe that this number is basically on the current number of 8 lakh crore, which will substantially grow to somewhere around 18 lakh crore by 2025. So the outsourced manufacturing opportunity will also increase from the range of 50 to 1 lakh to maybe 2 lakh crore in the upcoming 4 to 5 years. So now we have a strong growth way set for the industry in an Indian domain as well. So with this, now we will try to look how Hindustan Food is trying to capitalize on this growing industry to take it to the next leg. Yeah. So what Hindustan Food has done, so basically when they analyzed the segment of the FMCG, and they found very interesting opportunities across the different FMCG verticals. So they cherry picked some of the segments where they can see which has higher return on investment and very like high take rate from the Indian FMCG side as well. So they have started doing aggressive capex, which is announced in the ice cream segment. One is from the bath and soap segment. Another is from the healthcare side. One is on the color cosmetic side, and the footwear side, and the beverages side. So we would be very happy to announce that the new capex, which was healthcare and wellness, so the acquisition of this particular company for the Shoal has been completed yesterday only, and they have sent the communication to the exchanges as well that the acquisition is complete, and it will start to contribute to the Hindustan Foods revenue from this quarter as well, which is a Q2 of FY23. And the Uttar Pradesh plant, as Prabhat mentioned, has already started in the April a month, and Hyderabad plant is also expected to start somewhere around quarter 3 of this financial year. And color cosmetics plants has already started. Similarly, footwear segment where they announced a capex last year and again this year. So Vasai manufacturing facility has also started the production from this quarter. And if you look at the beverage segment, so now they have a strong visibility from the Hector Beverages side and also from the Tata Consumer side. So they are very optimistic, and they have announced additional 45 crore of capex across their two different plants. One is in Puducherry and another is in Coimbatore. So this is how the Hindustan Food has tried to capitalize on the growing industry of FMCG. And with this around 460 crore of new capex, the company is planning to grow its revenue somewhere around 2000 odd crore to 4000 odd crore. So maybe Prabhu, we can move to the next slide. Yeah. So the incremental 460 crore capex that we have just highlighted is spread across very different categories. And with this, company is expecting around asset turnover of 3 to 3.5x. So we have a headroom of around additional 2000 crore of revenue from the existing capex, and some of the new capex is also expected to announce because there are still 3 years left to this journey of reaching from 2000 odd crore to 4000 odd crore. But what we have seen in the stock market, the journey is never like a straight line growth. It's will have its bumpy ride. It will go up and down in each quarter in terms of revenue, or let's say some supply chain issues or some supply disruption. So if we look at in the past, like in the COVID times, we had like major disruption across supply chain, and again in Russia war, we have seen the major disruption coming from the inflation side and supply chain side. So in businesses or even in the stock market level, there will be always ups and downs, and there will not be a smooth ride. But we strongly believe when Hindustan Food has a strong track record of execution and long-term relationship with the clients. So we strongly believe that it has an upper hand and it has a higher odds of reaching its revenue mark of 4000 crore in next 3 years. So with this the journey that Hindustan Food has highlighted, but we also look at the other side of the part of the growth journey, which is the risk part. So we strongly believe that when we are tracking the business, we should focus more on the risk part of the businesses. So we have tried to capture some of the four major risks that we think can put some kind of hurdles to the growth journey of the Hindustan Food. Yeah. Please move to the next slide. Yeah. So we have basically captured the four major risks. So first is the demand slowdown. So as we have seen, like major disruptions coming from the supply chain and inflation side. So FMCG companies, which are the final brands like HUL, or the, let's say, the examples of like in the Bata, which is the footwear client for the company. So they can also put some orders in the next quarter, or let's say they can delay some order depending on the demand that they are showing from getting from the ground. So we think that there can be some demand slowdown. There can be some commodity risk which is coming from the raw material side. But as we have seen the three major types of manufacturing plants which Hindustan Food operates. So across all the three categories, they have a strong advantage of passing on the raw material prices to the end consumers. So they don't face margin pressure because of the volatility in the raw material side, especially in the dedicated manufacturing and the shared manufacturing facility. So delay can be 1 or 2 quarters, which is an accounting delay, not the operational delay. So as soon as the new inventory passes comes to the plant, it is the price is also increased for the finished goods. So there is no pressure on the margin side. So although on the operating side, there can be like a 1 or 2 quarter delay on the accounting side, but in operation, the delay is not there actually. So we don't see any major risk from the inflation side. Third is the execution risk. So because it's a manufacturing space, so we know that there can be some sudden disruption, or let's say some unforeseen event like the fire events, which is very common in the chemical plants or some of the FMCG plants, which are basically the manufacturing related issues of the supply chain and all. So we think there can be some disruption if happens. We need to be watchful of it. And the fourth is a business risk, which is a operational delay happening, and also some of the bottleneck issues which is related to basically the plant side. So if there is some internal issue with Hindustan Food is facing in terms of, let's say, the sourcing of the raw material, or let's say the availability is not there, or let's say the supply chain disruption is happening on the raw material side, especially because the inflation has moved quite a lot post the in Ukraine war, which is happening since somewhere around January 2022. But on the bright side, the inflation has started to come off very drastically in the May 2022. Somewhere around 15% correction is visible for the every commodity side. So we don't see like there will be any issue regarding the raw material availability or the pricing front side on the raw material as well. So these are the four risks that we think we need to be watchful of the journey of the Hindustan Food from reaching to 2K CR to 4,000 odd crore in terms of in the next 3 years for the revenue side. But we make sure that the journey will not be easy. The journey will have its ups and downs when the company is executing its order and getting the new clients. But with the strong track record and the past mistakes and the learnings from those past mistakes, which Hindustan Food has put in their business model, and they have redefined and improved that business model successfully in the last 5 to 6 years. So we are fairly optimistic, and we have higher odds of successing and reaching the revenue of 4,000 odd crores by the FY25. So I think that was it from our side on the business side. So, and thank you for listening us patiently. And over to you, Prabhu, and maybe we can move to the next section of the Q&A. Yeah, thank you.
Thank you, sir. So we'll start the question and answer session. So the first question is, the macroeconomic factors have been worsening. So what are some of the sectors that are favored by the current factors?
Sorry, Prabhu, can you please come back on the question side?
Yes, sir. So the macroeconomic factors have been worsening. So what are some of the sectors that are favored by the current factors?
Okay. So mainly, there are quite few sectors where their green shoots have been developing, right, and the macros have started to turn favorable. So one of the sector is auto side, where we have seen a huge raw material pressure in the last year, right, mainly in the Q3 and Q2, right, of FY22. So that has started to come off mainly because of the correction in the steel prices. And also, if you look at there was a semiconductor issue which was hampering the rollout of the volume, right, from the plant. So mainly we have started to see some sort of easing happening there, right, and mainly over the next 2 to 3 quarters we'll have some sort of more comfort there on the semiconductor issue side. And also third was what was happening is that the entire down cycle of last 4 years in the auto space, there was no much models models launches have been happening for companies like Maruti. So mainly what we have seen is that companies like M&M and Tata Motors have started to come up with new models, but Maruti also of late have they have this model launch in July month, and again they have a model launch during Diwali with Toyota. So mainly a lot of new model launches are happening, which are the growth triggers for the auto companies, right? So mainly because of the favorable macro environment, softening of raw material prices, steel prices, flat steel prices, also because of the easing in the semiconductor issue, and also mainly because of the new the model launches that have been slated for the later part of the year, we see that the macros for auto are quite favorably placed. I think for the other sectors which I can point.
Yeah, thank you.
So,
tell me.
Just to add on the the sector side. So a chemical is also interesting sector, because the businesses which are operating on the long-term contract side with the external clients, so they have very strong revenue visibility, and the immediate spike which we are seeing in the raw material, so they can last maybe 1 or 2 quarters in their business as well. But the pass on mechanism is very strong, and it makes the business model very solid. So when we see, let's say, the 1 or 2 quarters, the margins are coming under pressure for these specialty chemical companies, and let's say the most of the people are getting out, which are not very they don't have a proper knowledge regarding the business, how the business model works. So their image is a very strong opportunity. So one can always think and go and study the business and conduct and own due diligence, and also can take some position based on the analysis one has carried out. So we should always look for the businesses which have a strong revenue visibility across a multi-year, maybe 5-year, 7-year, 10-year kind of contracts. So this is a very strong point when it comes to the some short-term pressure like inflation or some supply chain disruption. So these are naturally protected, and whenever some kind of issues emerge in the market, so we naturally get a cool down in the stock price, and it can also help us to put additional capital into the same business that we like and we have analyzed over the period of time. So that can be also one sector. Yeah.
Right. Prabhu, I can see participants are slightly worried about the profit margin of the company, right? So just to answer those queries, I think there are 2, 3 questions on the similar line. The contract manufacturing business is a business where the profit margins are very limited, right? You have a scope to play between 2 to 4%. And even in case of Hindustan Foods, if you look at the profit margin of last 3 years, that has ranged from 2.5% to it has ranged in a similar trajectory, right? But even if you look at the growth in the business that the company has done, so it's around 70-80% kind of CAGR volume growth, right? The company has done, and mainly because of which the revenue has peaked and also the PAT of the company has peaked, right? So what the intention here is that although the margin could be if you compare to the other sectors, other segments, it looks quite weak, 2 to 4% kind of margin. But if you have the volume in the business, if you have the visibility on the PAT side, right, the profitability of the company can grow. So there is no as such worry on the profit margin side. So just to give an example, if you calculate the 2% margin or 2.5% margin on a sales of 2,000 crore, so that would be roughly 40 crore, right? If you take the 2,000 crore number to 4,000 crore in next 3 years, then the PAT will also double, even if the margin remains same. So obviously there will be some because of the volume expansion, the margin should also improve a bit of couple percentage points. But even if the margin remains same around 2%, so your PAT will doubling because your volumes are doubling and the revenues are doubling, right? So essentially you are getting at least 26 to 30% kind of compounding in a the mentioned time horizon. So mainly the thought process is you have to have a visibility on the revenue side. If the revenues are coming and the margins are for this business in the same range, right, 2 to 4%. And also there is a concern on the cost of borrowing side, how it can match up with the profit margin side. So unless and until we have seen that the ROE and the ROC of the business, it's around 14%, right? So if the return ratios are greater than the cost of borrowing, right, so it doesn't impact much the margin. It impacts only when you have huge leverage which is hitting into your PATs. Then your PAT is getting compressed and you're not getting that sort of compounding on the earning side that you have hoped for. But if it's 2%, it's fine. If the business is growing by more than 36, 35, 40% over next 3 to 4 year time horizon, that will take off the earnings growth. So yeah. Vijay, anything you would like to add here?
Yeah, just a point on the basically the how the businesses create the huge wealth, or how the value of the business works. So normally it's a function of free cash flow, and free cash flow is also a function of the two major things, which is a return on investment, which is a return on capital employed, and second thing is the growth. So we discussed in the one of the slide where we mentioned that Hindustan Food earns around 19% for each 100 rupees each invest in the business. So and if we put the same amount in the bank, we may get 6 to 7% depending on the type of bank and maturity we puts in. So for Hindustan Food, it's around somewhere around 19%. Of course, if the margin improves, return on capital employed can also improve. But the good thing about the business is that it's a huge growth. So basically return on capital employed, which is a capital efficiency, and another part is a growth. So we have seen a strong growth in the past, and the growth is also stronger for the next 3 years as companies already working on some of the new capex which they have announced. So with these two functions, the value of the businesses work go up because free cash flow go up, and according to that, your terminal value also goes up. So even if the margin remains in the same category, the reinvestment rate is too high for the company. It is generating somewhere around 19%, and they are investing around 26% and aggressively doing gross block expansion. So that makes us very confident of the valuation of the business should go up, because the inherent characteristics of the business in terms of return on capital employed and growth is very strong. If we compare with some of the large FMCG companies like Nestle or Hindustan Unilever, so they don't have the major require the quantum of growth. They can't grow their revenue at 25-30% CAGR because they have attained certain size, and the size becomes issue when you are too big in the market. So naturally you won't have a better growth rate compared to the market itself. So with this, we think that we have tried to answer the query on the basically the profit margin side and other issues side. Yeah.
Yeah, thank you, sir. So the next question: do you think the consumer space, will benefit considering the inflation trend and its impact?
Yeah. So consumer is a very broad segment. So maybe we will focus on one particular category. So when we are looking or passing through the inflationary environment, we should always focus which business has the pricing power, or which business has a power to pass on the rising raw material prices to the end user. So some of the examples can be the paint segment, which has a very strong pricing power, like the leaders of the paint segment, like Asian Paints and Berger Paints. Again, these are just not a recommendation, just a knowledge purpose names that we are mentioning. So these businesses have very strong like pricing power, and they pass on the rising raw material prices to the end users. And similarly, if we look at the FMCG businesses like Nestle or the HUL, so each inflation time they will take price hike. And the good thing is then when the commodities cool off, like it happened in the May 2022, they will not roll back the price hikes. Like Maggie, which used to be around 10 rupees somewhere, maybe 5-6 years back down the line, it grew up to the 12 rupees. Now it has become some 14 rupees. So we don't expect to go around 10 rupees, which was 5-6 years down the line, the price. And even if the inflation is coming down, crude oil prices are also coming down, they will not roll back the prices. Okay, so one needs to look for the businesses which have a strong pricing power, and they can reap this additional profit, because they might have suffered for 1 or 2 quarters because of the raw material prices, but now they have increased the prices. And when the commodity is cooling off for the next 3-4 years, so they will not decrease the price, so they will charge extraordinary profit, or they will keep on making those extraordinary profit. So that's why when we see the growth of the, let's say, the value add businesses like FMCG or the paint side, which are basically selling the consumer goods, and the commodity businesses like the steel plants, or let's say the crude oil refineries. So we find a very striking difference that the consumer businesses have a very strong compounding growth across the cycle in terms of the shareholders funds as well, and as well as the stock price as well. But when we compare the but when we look at the steel, or let's say the metals, or let's say the some of the names from the auto side, so they will have like a cyclical growth, and it will depend on completely on the cycle. The stock price may go up and again come down very sharply depending on the underlying commodity side. So that is a striking difference that we need to keep in mind when we are looking at the investment. So in consumer, we like segments like paints, FMCG. So this remains our key picks in the consumer segment. Yeah.
Yeah, thank you, sir. So the next question is, markets have been slowly trending downwards for the past few months. From your view, as the markets, bottomed out.
Yeah. So just to have my initial remarks, and maybe Prabhat can also add on this line. So we have seen like a very sharp disruption in supply chain in during the COVID times, and things started to improve somewhere in 2021 with the major economies reopening. But unfortunately, there then again new crisis came in terms of war, which pushed the crude oil prices and all the commodity prices to a newer level in March and April, so which has put again additional pressure and on the supply chain side, on the supply side mainly. So we think there were challenging times, and there are still like the commodities have not cooled off to the previous level. So we think there can be some additional pressure on the companies in terms of their P&L, maybe stretching 1 or 2 quarters. But we have when we have interacted with the companies in the recent quarter, so we have seen that majority of the players have taken the strong price hikes to pass on the raw material prices. So we don't see the company's profit coming under pressure maybe 1 or 2 quarters down the line. And if we look at the FII selling, so it's a completely different point, because FIIs have a very different objective when they are investing in some particular country. So they have very different, they have a basket of choices when they are picking the developing countries. It's not India. They can invest in, let's say, the Brazil or China. So they have very different choices. Okay, so their objective is completely different. And if you look at the FII selling, so I was just going through the number for the number for the 2021 and 2022. It was somewhere around 3.75 lakh crore. And if we compare this number with the past decade, so they sold around 1.75 lakh crore in the 2020 decade. So in 10 years, they sold around 1.75 lakh crore. And in these 2 years only, 2021 and 2022, they ended up selling 3.75 lakh crore. And if we again go back in past in 2008, so selling was somewhere around 1 lakh crore in the single year. So we have seen a historically high selling happening from the FII side. So there will be pressure on the stock prices side, but in our philosophy at Right Horizon, we believe in contrarian approach. So we don't focus on the daily stock prices. If the prices are going down and if we think that businesses are improving in terms of profits and business fundamentals, so we strongly believe that one needs to go and buy aggressively. Of course, on the market bottom side, like we don't expect any sudden rebound happening because the situation has been getting worse on the US side as well. But selective companies can start doing well, and maybe the bottom on the market level can happen, let's say, the next 2 quarters. Yeah. Maybe Prabhat can also add his view on this side.
Yeah, thanks, Vijay, for the input. So mainly on the, what we expect of the economy, right, going ahead. So mainly we have seen, the companies are struggling with the rising input cost. So that has a kind of level, it has normalized. So we have seen the raw prices, the raw material prices of important, FMCG companies like palm oil and wheat and all has, it has started to come down again on the consumption side. So the prices of steel have, has come down substantially by 20-25 odd percent in last 2 to 3 months, right? So and again, the government is doing all sort of measures. The recent being the yesterday's government announcement on the crude side, right? So maybe a lot of measures have been taken away the company, and which has led to the cool off in the input cost, right? But mainly what is happening that there is also destocking happening in the market, right? So based on our interactions with the companies, what we have felt is that this quarter the volumes are going to be dip a bit, mainly because of the destocking happening, and the prices will stabilize. So up till now we have seen high prices affecting the margin. Now the volumes will be impacted, and it will shrink the overall, or stabilize the overall P&L. And mainly from the quarter third, which is again the best quarter for consumption in India, right? We'll see the volumes started to go up and at a very comfortable and normalized pricing level, right? So mainly then we will see that the base effect will also be normalized, and the sequential quarter-on-quarter volume growth plus the cost pressure which is impacting the margins, that will also getting normalized. So from quarter three onwards, we have a view, at least in our coverage universe, that the companies have started to show a rebound in the P&L, and maybe from there we can see some sort of comeback happening in the overall market as well, right? So that was on the macro side. I hope that answers the question.
Yeah, thank you, sir. So the next question is any short-term view on logistics and packaging industries?
So we refrain to as per our philosophy, we refrain to pick some short-term trends because that is clearly against our objective that we are trying to compound over a period of time, let's say the 4-5 years. So we have a very strong focus on wealth creation, not a normal profit taking by some optimistic trades. So I think we will refrain by giving opinion on some short-term trends. Of course, there can be opportunities which can arise, but the size of that opportunity and also the entry and exit of the timing, which is also a timing issue. So we don't pursue it as per our philosophy. Yeah.
Thank you, sir. The last question is regarding HFL. Is it an asset-heavy business model? How about the capability of the business to generate free cash flow?
Yeah. So if we look at the Hindustan Food, so if we look at the aggressive expansion which is coming, and it's in the FMC space, so it's a capital intensive business. Again, it's a labor heavy business as well. but the quantum of growth is very high, and the particular level manufacturing plant had a very strict ROC requirement, which is a 19%. They need to have bare minimum 19% ROC, which can result in the compounding and also reflect in the financial statements. But we don't necessarily want a company to start generating free cash flow at this level, because the opportunity is too high. Let's say if they start generating heavy cash flows, it means that they are not deploying the capital, or they are not finding opportunity to compound the capital at 22 or 21% in the business. So management has a very clear view. They will keep on redeploying the capital, then incrementally when they are making, let's say, 20 or 21% kind of return on investment. But the day they find that the opportunities are shrinking, and the capex that they have done is hitting the ceiling limit, so they will start doing aggressively the buyback, and in terms of like improving the EPS and improving the ROE. So the management's focus is first in the growth part of the business, is to expand as much as possible, and also focus on the return on capital employed side. And once we hit the, let's say, the growth has normalized from 26 to, let's say, the 15% CAGR, or let's say the 10% CAGR, like Hindustan Unilever or Nestle kind of zone, so then company will start focusing on the generating heavy cash flows, because they will not be doing the capex. So when let's say in the case of the capex side that we presented, so for 460 crore of new gross block, one needs to have a working capital requirement as well, right? And one needs to have a combination of equity and debt, and also the internal capex operations cash flow, which will help them to finance the upcoming capex. So apart from capex, they also require heavy working capital investment. So that comes from the cash flow from operations only. So that's why we will see that the companies which are in growth phase will aggressively keep on investing in the building up inventories and taking up the, let's say, the raw materials in advance, because they know if they are growing from, let's say, 100 to 130, which is a 30% growth, so their inventory requirement will also increase by 30%. But there, if we look at in terms of working capital days, so it should not increase. So although the absolute quantum will keep on increasing, but we are very happy with the management stake that when we are in growth, so we should focus on the redeployment of capital at a higher rate, because if they are generating and redeploying at 22%, so that will similarly result in the balance sheet compounding and the stock price compounding. The day they start getting ROI on the incremental capital, let's say the 10-15%. So we think that there won't be a good time for us, because we majorly play on the compounding of the business and compounding of the capital side. We don't necessarily pick the dividend kind of business model. So that's strictly regarding the growth phase. When it becomes a mature business, we will see like the decent buybacks, and they are focusing on the free cash flow side, because they are not investing aggressively in the capex side. So there won't be higher capital requirement in terms of working capital or even in the gross block side. So I think I hope it clears your query. Yeah.
Yeah, thank you, sir. So due to time constraints, we would like to conclude the webinar. So if you have any further questions, you may reach out to us through phone or email, and we will be glad to answer. Thank you on behalf of Right Horizons. Thank you for joining us, and you may now disconnect.